let me just give you one quick sales idea. When interest rates are low, the majority of people, your clients, if not you, go out and refinance your debt. They take on lower interest mortgages, they take their debt and they restructure it. They do everything they can to get the lowest rate. What we're doing now in this environment with interest rates so much higher than they were, and the 10-year Treasury, I think, was at a 0.53 in July of 2021, I want to say, or 22. Now we're up over 4 and maybe over 5. And so with that kind of growth, how can you leverage that for your best interest of the client? Well, you want to refinance their retirement. You want to review every instrument that they're using for retirement, annuities, mutual fund, portfolio, whatever it is that they've got earmarked for retirement. You want to make sure that money is working hard for them. So without further ado, to continue this series, which is Refinance Your Retirement, I'm going to turn it over to Kent, who's going to go through Indexalyzer. Take it away, Kent.
Okay. Well, welcome, everybody. Thank you for having me on today. We're going to talk about specifically the index annuity products. And what I want to really go over with you is how you can use this information. You can use it, obviously, to sell index annuities, but you can also use it as you're gathering data with new clients you're meeting that more than likely own index annuities. So what we provide is information. We don't provide sales tools and all that kind of stuff. It is mainly about information. So what we're going to do is dive in. And is everybody seeing my screen okay now?
Perfect.
Perfect. Okay. So this is indexalyzer.com/ABN for Alpine Brokerage North. This is where you would go to get your subscription to it. We'll talk about that more when we do the deeper dive. What I want to talk about today is what's inside of here once you get your subscription. So we've got these available downloads. You got carrier reports, chart reports, top 50s, Reviewalizer, Calculator, Comparalizer, MIGA. So what we do here at the Index Resource Center with the Indexalyzer program is we back test. We look and see what have these products done in the past. And what we're going to show you today is why we do it better than everybody else and why the information that we have is so needed in the industry today. So I'm just going to go into a couple of these programs just for time's sake, just to kind of give you an overview. And then when we do the deeper dive, we'll hit them all. So I want to start with our carrier reports. So what Carrier Reports does is it literally allows you to select any index annuity. So we got all the carriers are listed here, and you select the one you want. I've selected Athene here, and then the next drop down is going to be all the products Athene offers. So I'm just looking at the Performance Elite 10. Now, this is an Excel spreadsheet. It will not be in Excel for very long. We've kind of built everything in Excel. I've always told people that, in this technology, financial technology world, a lot of the other companies out there are a bunch of techie guys that are trying to learn. They're trying to learn all the industry information. Well, I'm an industry guy, and we're trying to learn all the technology. My background is I've sold my first index annuity back in 1997. I was licensed in 95. I've worked at 7 different wholesaling companies, kind of like Alpine Brokerage North. I owned my own for almost 10 years. I was part of the committee that created the first income rider product in the index annuity. So I've got a lot of industry cred. So on the programming side, I built everything in Excel. I'm kind of an Excel geek. And now we've got, programmers like Michael's company has helped us to get these into actual programs. But what I want to point out about the spreadsheet is it is what I call a dynamic spreadsheet. So it has data being fed into it every day. Like Michael said, we update all the rate changes that happen instantly. And when those are updated on our system, they instantly hit every spreadsheet that's being used all across the country. So it's not like you have to keep re-downloading to get any changes. They automatically hit. As far as the index pricing, that also is updated daily. So when you're looking at numbers with Indexalyzer, you're looking at it from the prior day's close going back 10 years. So that is kind of the backbone of what we do. So now inside of Carrier Reports, I've just kind of set this up: Athene, Performance Elite 10, State of Arizona, age 55, 100,000, no drawdown. We'll talk about what this retro and the drawdown mean in a second. Let's go ahead and look at the report. So what you get on the report first is a detailed analysis of each index that's used inside the product. So you have nice data right there at your fingertips. So you can explain enough for a client to understand that you know what the index is about, what's inside of it. If you want more data, we have that, but this gives you a quick little blurb about each index, and it also shows you the launch date. The launch date is important because that's going to tell you whether or not the index has full 10 years of live data in it, or if there's some hypothetical mixed in it. Let's talk about that a second. Hypothetical data inside of an index is still real data. Every index that we track is a rules-based index. So in other words, the index provider, in this case, like AI Power, that's HSBC, UBS, NASDAQ, you know, and the NASDAQ FC, which is ran by Bank of America, they do not have a human being coming in and literally saying, I'm going to make this change in the index, or I'm going to make that change. We're going to go to cash. We're going to go back to, you know, that's not happening. They set the rules, and it's all basically done with a computer. And as the rules change, then they manage their index that way. If it is a human-based index like Claria from BlackRock, we do not track that because BlackRock doesn't even track it. They don't have 10 years of data on it. So everything we have is rules-based. So we still want you to understand, you know, if the index is fully live or fully hypothetical. We don't do any of the hypothetical back testing here at our firm. That's all done at the index level. So you get that information, and then we come down and you get the returns. So what this is doing, it is breaking down each crediting strategy in this annuity and showing you the 10-year historical. Now, what it's based on is using the current rates, the current par rate, bonus, fee, cap, whatever is built inside of it, and we're running it back over 10 years. And you're seeing these crazy returns. And this is probably something that's been an issue in your practice, whether you're selling index annuities or selling against them, is seeing all these returns. And these returns are the same returns you're going to see in every other third-party software and what you're going to see in the carrier's illustrations. Okay, right now we're sitting in a time period where we've got these crazy high interest rates. They're creating a huge option budget for the insurance company so they can set these par rates super high because they've got so much less cost. And we're throwing up against the last 10 years, which we had a stellar 9 years and a little bit of a pullback. So that's what's producing these historical returns. But the problem with these returns is they're just wrong. They are absolutely wrong. And again, not just in our stuff, they're wrong everywhere else you're looking at historical returns. Let me explain why. We have in our back in the product selection this thing called retro pricing. When you turn this on, let it calculate through and watch what happens to these returns. They all drop down tremendously because what's happening is the back testing is now being done the right way. Let me jump into a real quick PowerPoint here and show you exactly why this is happening. So when I look at a big sort from our software that includes all the companies, you're seeing these returns that are just absolutely ridiculous. 31%, 29%, 28%. Understand, those are annual compound returns for 10 years in a product where you can't lose it. I guess the only way you lose it is if a client pulls money out early or if there's a fee involved and the index never performs. So yes, a client could lose an index, but based on the movement of the index, they can't lose. And these are the historical returns. And they're just wrong. Here's why. If we look at current back testing, what they're doing is they're taking the pricing from today and they're applying it backwards against the last 10 years. Now, the problem with that and why it's wrong is because that will never happen. It's never happened in the history of index annuities going back to 1994. It's never going to happen in the future. We're never going to see a time where a client purchases an index annuity, owns it for 10 years, and then has the insurance company price out what the par rate, the cap rate, the spread rate would be. It just will, it is physically impossible to happen, but that's the way everybody's back testing. They are looking at the par rate today or the rates and the pricing, and they're applying it backwards. And that's just never going to happen, but that's how they're doing it. That's how we were doing it for a long time. What we have to find out is what was the pricing at the beginning of the back testing cycle, the time frame that you're looking at, the 10 years. Find out what the pricing was then and apply it moving forward. If we could accomplish that, then we would know exactly what would really happen inside of these products and what people would have actually experienced if they could jump in a time machine, go back and purchase these exact crediting methods. Well, the problem with that is it can't be done. If you got XYZ index that was created in 2022, you can't call the carrier and say, hey, what was your pricing 10 years ago? It doesn't work. It's impossible. I mean, the carriers are like, well, the index didn't even exist. We don't have pricing for it. Well, that's the breakthrough that we've had, and we call it retro pricing. What we've done is inside of our calculator, when we enter in today's rates into our calculator, what it does is it goes back 10 years. It changes all the economic data, the three things that affect that pricing: bond rates, treasury rates, volatility. We go back 10 years, calculate those numbers, and we plug them in, and that gives us where the par rate would have been 10 years ago. So we have a proprietary calculation that we use, and that calculation has been demonstrated. Actually, once we got it programmed, I got on a plane and flew to New York City, and within 2 days, I got in to see 10 banks. So I demonstrated this for S&P. I demonstrated this for Barclays. I demonstrated this for Goldman and 7 others. And they all analyzed it, looked at it, and said, hey, you're close enough. You're almost right on the money on what this would have been. So we've taken the time to do our due diligence and make sure our calculation method is sound. And so what it produces here, if we look at this sequence of return here, these returns, this is on the HSBC, the AI Powered Global Opportunities Index that Athene uses. The day I made this PowerPoint, these were the rates of return. Athene has that thing priced out at 190%. So there would be the credited interest the client would have received over the last 10 years. And yes, that is a 58.3 or 88% number. So when you throw $100,000 at that, look at the growth rate. It goes up to 683,000. That's a 21.20 annual compound return. Just absolutely absurd. Never going to happen. And again, back testing is wrong. I mean, we're never going to see this sequence happen. So why are we looking at it that way? When we look at it with retro pricing and we have that 65% par rate, there's your returns annually credited to the client. There's your growth pattern. And now it produces a return that much, much closer mirrors what people have actually experienced in these products. So again, these crazy rates of return that are being shown in all the other third-party softwares out there and the carrier illustrations, I'm sorry, they're just wrong. When we put in our retro pricing, that's what's creating a real look at what happened, a realistic look. If you would, again, jumped in a time machine, went back and bought these strategies, these are the numbers you would have experienced. Now, understand too that we're not changing that par rate year by year. All right, if we go back into the carrier reports section here, you know, the par rate's all adjusted down to what they would have been 10 years ago, but we're still back testing them based on that 106, that 76, that 59, staying that way for 10 years. And we all know that's not going to happen either. So what we also have inside of our tool here is a drawdown. So you can throw a 15% drawdown onto the retro pricing, and now that's going to lower the numbers down even more, because now what's happening is that par rate, yes, they get that in year 1 because it's contractually guaranteed. But year 2 through 10, we've now lowered that par rate by 15%. So now we have the new back-tested numbers simulating renewal reductions. And then you can reduce it at 15, you can reduce it at 30, you can reduce it at 60. And what now you can show a client is a range of historical returns that are much, much better in line. Yes, we still have a double digit there. I mean, that is what would have happened with that index. Now, will it reproduce its 10 years? We don't know that. That's impossible to tell. But at least we can show a more realistic number, something better than 27, 28% to a client on how these things really did, and bring these expectations way, way, way back down to earth and show clients a reality check of how these products really perform. See, it's it's calculating right there. I'm off site right now, so there it goes. So again, it's tied into our server. So that's what I mean by their dynamic spreadsheets. So now we've got these historical numbers that are much, much more in line with what index annuities really do. So that is our carrier report. So you have the option to look at whatever company, whatever product you come up against when you're meeting with new clients. You know, a lot of these clients own these annuities, and more than likely their agent's gone. The agent probably sold them, and you know they made a few sales, they upped their lifestyle. Then when they figured out they didn't know how to market themselves, they got out of the business. So you're probably running across a lot of index annuities out there, or even in your own book, you might have some older index annuities. So one of the best ways to check and kind of get a feel for how an older index annuity is performing is with another one of our programs called Indexalyzer. What Indexalyzer does is it allows you to take your client's annual statement and plug in exactly what's being offered. So you just enter in their name, put in the product name, and then you go through and you enter in, even if there's no money allocated to that option, you enter it in. So up here's the fixed. So this is an actual real client. So they have no money allocated towards the fixed. The current rate was 1.85 and it's renewing at 1.85. So you plug that in, it's going to instantly calculate that 10-year historical return. Then you go down to the index options. Again, if there's no money, that's okay. You still put it in. So they have nothing allocated to this S&P annual reset monthly sum. The rate did stay the same. And whenever you use a cap or spread, you need to put in your 100% par, and it's going to calculate that 10-year historical return. And then when you have money in, so this case, they had 173,000 allocated to this annual reset BNP Paribas, and you put in the rates. Now notice here on this next one, this Morningstar, the rate went down. Everything else so far has stayed the same. This one went down. Next one stayed the same. This 8% risk control had a drop. One of the toughest things to do in a review appointment, whether it's your client or a new client, is when they ask that question, why did that rate go down? And I know that, all over the industry, everybody's like, oh, okay, well, Athene does a good job holding the rates, and American Equity does a good job. National Western Carrier, they start comparing carrier to carrier. The carrier has very little to do with it, okay? Unless like in the National Western, where if you actually read their entire disclosures, they tell you that they're going to lower the rate. But it's really not a carrier by carrier instance that makes these rates go down. It's the index. It's the volatility, it's the bonds, it's the treasuries. And so what we provide is whenever a rate drops, like in this Morningstar, in this Janus here, where there's a drop, we provide an explanations page where it'll show what the drop is, it'll show the index, and then it'll look at the three economic factors. It'll look at bonds. So in this case, bonds went down. That could cause your rate to decline. Treasuries, they went up. That could cause your rate to stay the same or increase. Volatility went up. That could cause it to decline. So now you can actually tell a client the truth. The Bible says the truth shall set you free. The truth is volatility and bonds worsen. So that's why they had to lower your rate, Mr. Client, Mrs. Client. So now you're telling the truth, and it makes you sound way more professional than saying, well, it was the economy or it was inflation. So this gives you the actual data of why certain crediting methods had a rate drop and other ones didn't. Now, obviously, there's two other factors here. You got, is the insurance company making money that year? Well, you're never going to know that. You call and ask that question, they'll probably laugh at you. Was this product sold during a fire sale? Fire sale usually happens between October, November, December. It's when if the earnings that they projected to their shareholders last year, if they're coming in shy of those earnings, they're going to artificially increase their rates to drive premium in the door to get their earnings back in line. Well, they're not going to give that money away free. They're going to take it back in the future. So there might be some times where you run this report and everything's showing that the rate should have stayed the same or increased, but they had a rate drop. The first thing you want to do is look at when was it sold. October, November, December, it was probably a fire sale. That's because they're going to make up for it a little bit at a time in the future years when that thing sold as a fire sale. So that's one report it gives. The second report it gives is it gives you a chance to show, okay, here's your current allocation, there's your historical return. And then it actually gives you 4 preset reallocation options to see if you can increase their chances by upping their historical return. So it gives you exactly how to allocate and which ones you want to move into. And then the last one is a custom. So back on the data screen over here, the last column is now that you're seeing what the historicals are, you can do your own reallocation and it will show up here on the output. So now you've got a nice little one-page report that you can take in, and that's your reallocation plan. So it's a really, agents that are using this with their clients, I mean, it just takes out all the guesswork, and it makes going to review appointments a lot easier, because I was an agent and I hated those review appointments as much as you guys probably do. Now, you guys being registered reps, you have other reasons to see people, so it's not as bad as just your life license only agent out there. But at least now you can walk in and you're not going to get beat up as much because you can go in with a plan. Reviewalizer is a great tool to use if you're meeting somebody and they have an index annuity, and if you can show how badly it's performed, it might be a good opportunity to move them into something else. Especially after you use Michael's software, maybe they need to get out of annuities and go into a RILA or go into a VA or something to get that structure set, that 70-30 and all that kind of stuff set even better. Or maybe they need to move into a new index annuity, maybe one with an income rider. Validate Michael's software that shows what those probabilities of hitting their retirement goals are. Either way, it's going to give you the data, and that's what we do here. We provide you the correct data on how these index annuities have performed, whether it's current ones or the new ones for sale. So that is
Can I just jump in real quick? Can I just jump in real quick?
Go right ahead.
All right, so guys, it's important to understand this is not your father's insurance company or insurance industry. I mean, this is totally different now. We're being forced not only by the regulators, but by consumers. They want more information. They want to know what our value is. These kinds of software programs are now being made available for you guys to use so you can actually demonstrate what your value is to that client versus some robo-advisor. I mean, you have to unfortunately defend every transaction that you actually put your license on. But in the end, you need to have some level of objectivity, and that's what this does. This creates not only the objective part, but it also gives you some historical data that you can use to make sales. Now, I can tell you, many of you have had the tough conversation with the clients that said, well, the cap was 7%, and then after that, it went to 2%, and that's all they had for all those years. And that's a tough conversation to have, particularly when your client calls up and says, well, I saw all the lift in the market. How come I'm not getting that lift? And I've had those conversations myself. Now, some of the carriers are getting ahead of this, and they're creating a platform where the cap is guaranteed for a period of time. Yes. We have a product right now where the cap is guaranteed for 7 years at 10%. So in that situation, you're taking out a lot of the guesswork. So you need to know what products are out there and available. We are doing everything we can to try and give you guys good guidance, good information, and good solutions that you can present to your clients. So, yeah. Without you, we're nothing, but understand that you can't just go out there willy-nilly now and make a sale. You've got to know what you're talking about, because clients are making sure they're going to put their money with people that know what they're talking about. These kinds of programs help to legitimize that and also give you better information to make a more intelligent decision with the client. Go ahead, Ken.
Yeah, and I love how you put that. It's not your father's industry anymore, because, like I said, I sold my first index annuity back in 1997. At that time, we had the S&P 500. And once we got through, the late 90s, we saw a Treasury index come out. We saw a bond index, the Lehman Brothers index came out. And then once we got into the 2000s, it erupted. When I started the Index Resource Center back in 2019, by that time, from 1994 to 2019, there was about 67 indices being used inside of products. Today, we're now, I believe, with the new ones we're adding, we're going to be close to 188. 188. Wow. So that means from 2019 to now, we've added right around 120 new indices. And I'm telling you, we have a relationship with a lot of these banks. They're actually clients of ours, and they use Indexalyzer. We have a special version of Indexalyzer that they use where they can take a new index that they've created, plug it into Indexalyzer, it converts it to a crediting strategy so they can see how their new index is going to compete before they even call the carrier and get it put in a product. And I'm telling you, there are hundreds of new indexes that you haven't even seen yet that they're planning on putting inside of products. And it's just going to keep growing and growing and growing. And you have to understand that, like Greg said, the clients need to understand that you know what you're doing. And that's what Indexalyzer helps you demonstrate. Because, you walk into an attorney's office, what do you see? You see bookshelf after bookshelf after bookshelf, completely filled with all these law books. The lawyers don't have all those laws memorized. They don't know it off the top of their head, but they know where to get it. Why do you think they put all those books out? As soon as you walk in, you see them. That's because they want to display to the client that, hey, whatever your problem is, I know where to find the answer. And that's what you have to become in the industry today. Because like Greg said, it's not your father's industry. It's not about just knowing the S&P 500 anymore, or even just the S&P, the NASDAQ, and the Dow, maybe the Dow Euro. It's almost 190 indexes that are built inside of all these products. There's no way you're going to learn 190 unless you're some kind of savant. You need to display and demonstrate to your clients that you have the tools at your disposal to find the information that you need quickly. And that's what Indexalyzer really does for you. And it doesn't just give you the rates. The rates, you can get the rates anywhere. You can get the rates with our stuff too. The rates are all over the place. But it's that back testing. It's that correct back testing that's going to show what these products really done. Because these days of 20, 22, 27, 30%, they have to end. If they were real, I'd be fine with it. If they were mathematically possible, that's fine. But they're not. They're not. Back testing's wrong. We do it the right way, and we can give you the numbers that are more in line with what people actually experience. So when you're talking to a client, you're going to give them an accurate depiction of what either their current product they own is doing, or if they're looking at purchasing one, what they can truly expect out of buying that product. And does it line up with their plan? So we're not here to make index news look great. We're not here to make index news look poor. We're here to give you the data so you can use that data however you need to use it in every different client scenario. All right. And we can take some questions now, Greg.
I love it. Yeah, if there are any questions, please type them into the chat box. Michael and Kent are going to be on for a few more minutes to answer some questions. But, I do want to just remind everyone, this is not a function of, well, index annuities are the answer for everything. That's not the case. But if you are designing a portfolio for a client, they have to have something that's going to defend against downward risk. And that's exactly what these products provide. The market has had a great run. We've hit a couple of bumps along the way. We will continue to hit some bumps, but the market overall through the years will always go forward. The question is the sequence of returns, which is exactly what Kent spoke about, and Michael, because you need to make sure that the client doesn't run out of money when the time comes that they retire, because they'll be in a situation where they have increasing costs and steady income. And that's really a recipe for disaster for people that did not plan appropriately.
Yeah,
are there any questions in queue?
Yeah.
Are there any questions in queue? I do not see any. Okay,
well,
we did a great job.
Either put them to sleep or I really explained it well. One of the two.
I think you did. I think you did great. Okay, I want to thank both of you for your time today and imparting this knowledge into us. Everyone here, I'm sure, appreciates what you bring to the table. And for those of you that want to pursue more information regarding these particular programs and platforms, we will be in touch, sending out follow-up emails for individual training for each particular program. So thank you, Kent. Thank you, Michael. Thank you, every one of you, for coming on board and sitting in on our session today. Good luck and good selling. Thank you.